This episode covers the 10 steps of accounting cycles. For our start, let's define the accounting cycle first. Accounting cycle is the sequence of accounting procedures used to classify, record, and summarize accounting information. The term indicates that these procedures must be repeated continuously and consistently to update the financial statements at reasonable intervals. The 10 steps of the accounting cycle are analyzing and classifying, journalizing, posting to general ledger, preparing unadjusted trial balance, preparing adjusting entries, preparing adjusted trial balance, preparing financial statements, recording closing entries, preparing closing trial balance, recording reversing entries. Step 1: Analyzing and classifying. Analyzing is the process of identifying the nature of the transaction or events, while classifying is the process of determining how the transaction or events impacts the owner's equity, the different assets, and liabilities before recording the transaction. It includes determining the exact account titles to be used in recording the transaction or events. For example, the bookkeeper, by examining the invoice, is able to identify that the transaction is a purchase, on credit, by the company of one laptop, because it is issued by its supplier, and the term indicated is 30 days. This process illustrates the analyzing process. She then identified office equipment to be debited, and the liability account of accounts payable to be credited. This process is what is called classifying. Step 2: Journalizing. It is the process of recording the journal entry of a given transaction in the general journal. The date, description or particulars of the transaction or event should be indicated. For example, journalizing or recording the purchase of one laptop, on credit, on September 18, 2020, for $1,000 means in the general journal you will debit office equipment for $1,000 to increase the company's asset account and credit accounts payable for $1,000 to increase the company's liability account. Step 3: Posting from the journals to general ledger. Is the process of posting all journal entries to general ledger on a per account and per transaction basis. Using our previous example, this means that the September 18 journal entry of debit office equipment for $1,000 must be posted to the general ledger of office equipment by debiting the same amount of $1,000, while the accounts payable for $1,000 must be posted to the general ledger of accounts payable by crediting the same amount of $1,000. Step 4: Preparing the unadjusted trial balance. The unadjusted trial balance is the list of all account titles with their net debit or credit general ledger balances. The objective is to prove the correctness of the previous steps and equality of debits and credits in compliance with the accounting equation. This is also done to determine the required adjustments, if any, that must be taken up in the next step. Step 5: Recording adjusting entries. Adjusting entries include, but not limited to, entries that ensure the matching principle is complied with, previous erroneous entries are corrected, to take up unrecorded transactions or events, reclassification of accounts, etc. Example: an advance monthly rent for 6 months of $6,000 covering October 1, 2020, to March 30, 2021. Is recorded on October 1, 2020, as rent expense of $6,000. The adjusting entry on October 31 is debit prepaid rent $5,000 and credit rent expense $5,000. This is to put the rental expense for October to $1,000 only, applying the matching principle of revenue and expense. Step 6: Preparing the adjusted trial balance. All the adjusting journal entries are posted to the general ledger of each of the accounts, and as a result, an updated general ledger balance is generated. This is an example of an adjusted trial balance which is based on adjusted net general ledger balances of each account as impacted by the adjusting entries. Step 7: Preparing financial statements. Based on the individual balances of each of the accounts on the adjusted trial balance, the following statements are prepared: 1. Balance sheet, 2. Income statement, 3. Statement of changes in stockholders' equity, 4. Cash flow. Step 8: Recording closing entries. It is the process of transferring the balances of nominal accounts like revenues, expenses, and drawings, to the owner's equity or retained earnings account, at the end of an accounting period. To illustrate, let's assume that ABC Company, for September 2020 has the following: total revenues $10,000, total expenses $8,000, and net income $2,000. The closing entry for September 30, 2020, would have to be debit revenues $10,000, credit expenses $8,000, and credit retained earnings $2,000. Step 9. Preparing a closing trial balance. Once the closing entries are done, and posted to General Ledger, the final trial balance is prepared, which individual accounts now only include the permanent accounts of assets, liabilities and capital or owner's equity. This is done to ensure that the total debits equal the total credits following the accounting equation. Step 10. Recording reversing entries. For better appreciation, assume the accounting period in cycle 1 to 9 is September 1 to 30, 2020, so that the new accounting period after that is naturally October 1 to 31, 2020. Recording the reversing entries means that the closing entry for September 30 would have to be reversed on October 1, 2020, the beginning of the new period, by a debit expenses $8,000, debit retained earnings $2,000, credit revenues $10,000.